bags. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough problem of how to properly record sales allowances for inventory. So if you're unfamiliar with the process, don't fret, gang. I dropped a link to get you up to speed in no time. So with that being said, let's get it. So it tells us to journalize following sales transactions for Lucy's Boutique. Explanations are not required. The company estimates sales return at the end of each month. Journalize the sales transactions. Explanations are not required. All right, gang. So a quick recap about inventory. We know that when we're dealing with inventory, a merchandising company has two particular sides that always needs to be addressed. The selling side of inventory to the customers and the purchasing side of inventory from the suppliers. In this transaction, we are accounting for sales allowance. Now, what is a sales allowance, you may ask? Sales allowance is similar to a sales return in the fact that we grant the allowance to the customers. Now, when we say an allowance, we mean we grant an amount reduced from the initial purchase price. For example, say you bought a pair of tennis from me for $100. Well, you call back and you say, you know what, my heels are falling apart.
Just do it!
I tell you, you know what, keep the shoes, don't do a return. What I'm going to do is grant you an allowance of $10. In all actuality, I've just reduced your price or your cost for the particular shoes. Now, on my side of the gun, this is considered a sales allowance, which should ultimately affect my revenue. So, at the end of each particular period, companies make estimates based on the amount of inventory they expect to be returned, thus affecting two accounts: your refunds payable and your estimated inventory return payables. Refund payables, just like the last name tells us, is a liability. Your estimated returns inventory is an asset account. Now, when the following period occurs and there are actually returns or allowances being granted, one or two of those accounts will be affected. Gang, the difference between an allowance and a return is that the customer keeps the inventory. And we know that when we have a sales return, we have two separate transactions that must be accounted for. One for the inventory and one for the actual refund. However, since no inventory is being brought back from the company standpoint, when an allowance is created, we just have one transaction that affects the actual refund. So with that being said, let's attack this problem. So it tells us on March 3rd, Lucy sold $63,000 of women's clothing on account. Credit terms was $310, net $30. To Maria's dress, the cost of goods is $35,000. Okay, gang, first things first. When we are selling inventory, we have two separate transactions that must be addressed. One to account for revenue and the other to account for cost of goods sold, i.e. inventory. We know that whenever we're accounting for revenue, we will always utilize the largest number of the two, gang. Why? Because we know that we never sell inventory at the price of cost. So whenever we are dealing with sales, we are going to always record the revenues for the largest amount between the two. So in this particular transaction, we have discount terms of $310, net $30. Gang, these discount terms simply mean that we're going to give our customer a 3% discount if they pay within 10 days from today, or they have to pay their entire amount within 30 days. Now, since we're given a discount term for this particular sale, we're going to assume that the customer is going to take full advantage of the discount right now, which means we're going to net the discount from the initial sale of $63,000. So how will we do that? Simple, gang. $63,000 was the gross sales of the inventory that was sold, but we're assuming that the customers are going to take that discount, and so we're going to subtract 3% from $63,000, and that's going to be the amount in which we're going to record our initial revenue for. Therefore, we're going to debit account receivable and credit sales revenue for the difference between $63,000 minus 3%, which gives us $61,100. 110. We're going to check the answer. Nice work, gang. Next, we must remember to account for the inventory. And since we sold some inventory, we now have to recognize the cost of goods sold, which is the expense that arises upon selling inventory. Therefore, we're going to debit cost of goods sold and credit merchandise inventory at the cost amount, gang, of $35,000. We're going to check our answer. Fantastic. Now on March 7th, it tells us that Lucy granted a sales allowance of $100 for the close on March 3rd. Okay, gang, so we have given our customer a $100 allowance for the inventory. But we know that the previous period we had already recognized the estimate for returns and allowances. We have created an actual liability called returns payable. That liability represents the amount that we owe for a particular return or an allowance. And so since we're going to reduce the amount that's owed to us for the inventory, we're going to debit refunds payable and credit accounts receivable for $100. Now, gang, since this is an allowance and not a return, it has no effect on our estimated inventory returns or our inventory accounts. So this is the only transaction that must be recognized. We're going to check the answer. Fantastic. And lastly, on March 10th, Lucy received a payment from Maria's Dresses in the amount due less allowances and a discount. Okay, gang, so it is now March 10th. And we knew on March 3rd, we had a sale. That particular sale had discount terms within the contract. And so we know that these discount terms were satisfied. Why? Because the customer paid within 10 days from the initial sale of March 3rd. So we are going to collect on this particular account. And since we already assumed that these customers were going to utilize this discount, we're going to simply record this like a normal collection on the account minus the $100 allowance that was given, thus affecting our accounts receivable. Therefore, we're going to debit cash and credit accounts receivable for the total amount of $61,110 minus the allowance of $100, which give us a total of $61,010. We're going to check the answer. Nice work, gang. So there you have it. A quick, easy illustration of how to properly account for sales allowance. If that light bulb clicked, which I know it did, please like, subscribe, and share the channel with your friends so they can chase the bags as well. As always, gang, I'm Dr. Who, and it's my humble pleasure to have you guys spend your time with me, and I'll see you soon. Bags!